Good morning and welcome to the Memorial Day edition of the Daily Huddle and a special edition of Money Monday. We're excited to be here with you guys this morning. And in our true fashion, I'll tell you that my wife and I just took out life insurance policies on each other. And now it's just a waiting game.
Cheesy Zack joke.
You know, the life expectancy for male is way shorter than.
I know. I know. We'll see who wins. I usually win. Well, good morning, everybody. Zach's already told you good morning, so I'm going to say so too. I'm Kimberly. This is my husband, Zach, and we are your hosts today for Money Monday. And today we're going to talk about that bank on yourself concept that everybody loves so much and they talk about all the time, all over the internet, everything you see. But before we do that, we have a few questions for you guys. So, Zach, you have a question? I have a question. Gio, you ready? What time is it and what are you grateful for?
The time is, let me see, now. The time is now. And what am I grateful for? I am grateful for the opportunity to self-reflect.
Awesome. Well, thank you for joining us today. Very much so. Chase, where are you and who will you hug today?
I am right here in this very moment. And today, I will hug myself twice.
Extra special today?
Extra special today. I need an extra hug today.
Awesome. Sorrel, how are you?
I was hoping you'd ask me that question.
Who you're hugging?
No. Huh?
I was like, we can do it both.
Yeah. I am a miracle worker.
Oh.
Where I am, miracles happen.
That's pretty awesome.
Yeah.
Glad to know you.
Yeah.
I like people that make magic happen, miracles happen.
Yeah.
Yeah, we're right here together this morning. So we're thankful to be here with everyone. Again, like I said, it's Memorial Day. So as a former history teacher, I would give you a brief history lesson about Memorial Day. Memorial Day was originally called Decoration Day because it was the day that everyone went and hung decorations on the graves of the fallen soldiers that had served their country, and later it became known as Memorial Day. And so people are a lot of times confused about the different holidays: Memorial Day, Labor Day, Veterans Day. And Memorial Day is set aside simply to remember and honor those soldiers, both men and women, that died in service of their country, and give us the ability to make our own choices and to be here and do these kind of things today. So I'm grateful for that, and I'm thankful for that, and we'll remember that as we go through the day and gather with friends and share time and those kind of things. But our topic for the day, beyond that, is this bank on yourself concept, also known as infinite banking. There's been a couple of different books that have been written about these things, and the concept itself there's several different variations to it, but we've gotten a lot of questions. I would say, again, we got them several years ago. I think the first book that I remember was back in 2009 that came out, and that one was actually called Bank on Yourself. And teaching people the concept of, we ask a lot of times, why is it that all the banks own all the big buildings in the towns? why when you drive, if you're in Atlanta, you drive around that banking corner right there, where you see the Wells Fargo building and all the other bank buildings. It's because they understand something about the fact that interest compounds, and if they loan money out and charge interest, they get back everything. In theory, they get back everything they've lent, as well as an interest rate. And most of us as consumers want whatever it is we're buying, so we're willing to pay more than it actually costs in order to get it right now. And so the concept of banking on yourself means borrowing money from yourself and paying yourself a rate of return. So it's a very basic concept that requires a couple of different things. First of all, if I want to borrow money from myself to go buy a car, I need to have that much money in order to loan it to myself. So that's the first misnomer of the bank on yourself concept. We have a lot of folks that get really excited and they say, well, I want to set aside $500 a month and I want to start borrowing from myself tomorrow, and I don't want to use the bank anymore for that. And well, okay, what do you want to borrow for? Well, I need to buy a new car. Well, there's no magic bullet out there that I'm aware of where I can deposit $500 this month and borrow $20,000 next month without going and borrowing it from someone else that has it. So the first thing about banking on yourself is realize that it takes time to accumulate the assets in order to make this program work for you. It's worked for generations for some families that you've probably heard of before. There's also another book out there called What Would the Rockefellers Do? That was a guy, I think Garrett Gunderson is the guy that wrote that book. He's an interesting guy, but he's got some history, again, tied into how several wealthy families from that same time period are no longer wealthy families. But the Rockefeller family was able to sustain and grow wealth through the use of life insurance products. And by having family banks, where as kids came through the system, if you will, instead of going to their local bank friend, they went to the local family board and they said, this is my income, this is what I have, I want to be able to pay this back. And they would borrow from the family bank and in turn pay the family bank interest. All those things, to my knowledge, and the different pieces to those are founded, and they're foundationally in life insurance because of some of the accumulation and the taxation that the government allows that to happen. People say, well, why would the government allow a tax-free accumulation inside a life insurance policy? Why would the government allow tax-free distribution inside a life insurance policy? That also goes way back historically to when the life insurance companies at the time bailed out our federal government back in the Depression era, right? And they still hold a lot of war bonds, believe it or not, some of the original companies. So it started out where the government gave tax incentives to life insurance, so that because they didn't want to take care of a bunch of widows and orphans. They called it the widow and orphan rule when it came to the tax treatment of a life insurance policy. So they wanted to incentivize people to plan ahead for their own families instead of waiting for the government to have to take care of them at a later time. So all those things play into the perfect storm, which now when we put the new fancy life insurance products that we have out there and the accumulation tools that we have, along with those tax treatments and those accumulation treatments that are inside life insurance policies from a governmental standpoint, it gives you a really, really strong tool if you use it in the proper way.
Yeah, let me talk now.
Yeah.
My turn. I think it's probably no secret that I love life insurance. I think life insurance is the cornerstone of most financial plans. Obviously, a death benefit, number one, to take care of your family or your responsibilities if something happens to you, but also using it as a financial tool, not just that death benefit piece, to me is awesome. We talked last week about using it for college education. It's not required to report on the FAFSA, which is the governmental piece that says, where's all your money? Life insurance, you don't have any money, you have a death benefit, right? So they don't see all of that money inside that policy. So I think as long as you understand how those policies work and you fund them properly and they're structured properly, they're a great tool. There are a lot of people that use life insurance to fund real estate investments. There are a lot of people that use life insurance, like I said, to fund college education, to fund major purchases, buy a car instead of borrowing from a bank, things like that. And the benefit behind that is, number one, well, maybe not number one, but multiple benefits, right? You don't have to qualify for a loan. You don't have to go to the bank and say, hey, I'm worthy, because it's your money. And you have the ability to borrow that from yourself. As long as you have money in there and you follow the rules of the insurance company, then you can borrow money from yourself tax-free. How is that tax-free? How does that work? Why do they not tax your investment? Why do they not tax your cash value? Because proceeds from a loan aren't taxable, right? You're not actually withdrawing money from this policy, you're borrowing against it. It's just like a mortgage on your house. If you had a mortgage on your house and you wanted to do a bunch of repairs and you did a cash out refinance and pulled $100,000 out to fix your roof and do modifications and things like that, that $100,000 isn't taxable. Exactly the same thing in a life insurance policy. A loan is not taxable. So I think that's a really important piece to understand, is it's after tax dollars going in, right? It's out of your checking account. It's growing tax deferred. And as long as you follow the rules, it's complete tax-free access on the back end. But I think another piece that's different from just saving it in a savings account, right, is people are like, well, if I'm going to save $500 a month, I won't pay the cost of insurance. I'll just put it into a savings account and do so. Just totally lost my train of thought.
We were talking about what we were showing earlier, and
Oh, I
there's some
know what I was
really
gonna
cool
say.
graphs and things like
Yeah,
that. But
thank you.
go ahead.
Thanks for that. Helps for him to know my brain, right? But in a savings account, when you put money in there and you grow that money and you pull it out, it's gone, right? So in order to grow money again, you have to put it back, or you have to start putting it back on a monthly basis. In an insurance policy, when you borrow money from that policy, it doesn't actually leave the cash value because it is a loan. So you haven't actually taken that cash value out of your policy. You've only taken a loan from the insurance company. So that cash value continues to grow, even though you've borrowed money against it. So that's another reason why people really, really love these policies. Do you want to say anything before I talk about?
Well, I think that, and we shoot for a lot of times when we're helping clients or we're answering questions, the big thing in retirement is an income stream and how long it lasts and how much you need. But the biggest thing is not outliving that income stream. So when we look at vehicles that allow and if you're familiar with the investment world, and the general rule of thumb used to be a 4% drawdown of your asset accounts on an annual basis was what you should aim for. Well, that's been reduced in recent years to say that if you take out more than 3%, you're going to run out of money.
Probably could be as low as 2.
What we find, because of volatility, right? And in this situation, we're kind of off the bank on yourself concept, but to add to what Kimberly was saying about why life insurance works this way, is that when I take money out of my 401k, if I have $500,000 for a round number in my 401k and I take out $50,000 that first year, and I want to have a $50,000 income, I actually have to take out $70,000 because I have to pay tax in order to get that $50,000. So if I go into my life insurance policy, not only am I not withdrawing the funds, but I'm borrowing $50,000. I'm not borrowing 70. So I can borrow that money out of my life insurance policy and not pay tax on it. So in essence, the entire portion of my life insurance cash value is still getting credited at whatever rate of return that type of product is set up to get, right? Whereas in the 401k, when I pull it out, or any kind of retirement account, when I pull it out to use it, I have to usually pay tax on that money. So I have to pull out more money in order to do that. And then that money's gone. It's no longer growing in value. It's not accumulating for future income's sake. So
I think some things to think about. I'm a huge fan of 2 different life insurance policies, a minimum of 2. You can have as many as you want, right? That was a big question somebody asked me the other day is how many life insurance policies can I have? Well, ultimately, as long as it's suitable, it's about your death benefit, not about the number of policies. And as long as an insurance company believes that you have the insurable need for
Mhm.
however large your death benefit is, you can have that. But I'm a fan of a minimum of 2 policies. If you can afford to do the permanent piece, if you can't, term first, period. But I think a term policy is super important because it's going to give you a large death benefit for a small amount of money, and it's going to cover you for a longer period of time. In order to do the bank on yourself concept, infinity banking, whatever you want to call it, in those policies, it should be structured where it's minimum death benefit, maximum cash value. We want all of your money, as much of your money as possible in those accounts to grow, not just pay for a death benefit. So that's where I see a lot of times I see issues when I look at other people's policies is that they've been sold this huge death benefit, but they're not putting money in there enough to fund it to actually grow that cash value. That's where I think you have your big death benefit in a term policy, and you have your minimum death benefit just to hold enough for your money to grow. Your death benefit is what determines how much money you can put into the policy. And that's an IRS, regulation rule because they don't want you to, just put $1 million in the policy with $100,000 of death benefit, right? You always have to have a little more insurance than you have cash value.
They found that loophole really quickly when back in the 80s people were doing that. They were buying $100,000 worth of permanent life insurance and throwing $1 million in it.
They're like,
And the IRS was like, wait a minute, that's not going to work for us long term. So they fixed that with several different formulas and those kind of things. Didn't change the treatment of it, but they made you keep a
made
balance
it be in
there.
proportion.
Yeah.
Right.
The other thing I'll say about death benefit and how much you can put in the policy. Yes, the size of your death benefit bucket, as we call it, tells you how much money you can actually put in that on an annual basis or every year, every 7 years, and there's a calculation for that. But one of the things that frustrates me the most about the marketplace is that the size of the death benefit also determines the commission that the agent gets. So one of the things that gets these concepts a bad name is aggressive agents that are selling the wrong way. So it's very important when you use a concept like this, like Kimberly said, that a large chunk of the money you're putting in that policy every month is going to accumulate cash value, not going to buy insurance. So if somebody sees their income is going to be higher in a year or 2 years, then we don't want to start with an insurance policy that's going to hold 3 times what they're going to put in. We want to start with one that's going to grow with what they can afford to put in now. And we plan for that future by doing additional policies and other things like that down the road. So
yeah, so lots of different options, lots of different thoughts. Obviously, the tax-free treatment is huge. The borrowing from yourself and banking on yourself and having access to your money under your terms is a big deal. As long as it's structured properly, which we just talked about. Another piece is, obviously, first and foremost is the death benefit. So you have to have the ability to, or the need for a death benefit from an insurance company perspective, but you also have to qualify. So remember that if you're in poor health and you can't qualify for a death benefit, what are your options? Well, technically, as long as you have insurable interest, if Zack had some issue and he wasn't insurable and we wanted to do one of these bank on yourself policies, he could put that policy on myself, on my life, right? Because he has an insurable interest in me, even if he's the owner of that policy, and fund it for himself, for his rules, for his use, using my life. So he could borrow my life. So lots of different ways to make it work. But I think just understanding that it is a very valid, very valuable concept. But I think, like Zack said, the conversations that I've had a lot lately have come from some real estate investors, and they're like, hey, I want to be able to bank on myself and borrow this money when I want to. When I make these huge windfalls, I want to dump it back in, and then I want to borrow again, which makes sense, right? That's the infinite banking concept, is that you just continue over and over and over and over and leverage your money over and over and over again. The only issue, or the biggest issue, that I think we've seen in the last several months, maybe year or two, it's super popular on TikTok. I'm sure you guys see it all over social media. People, if you follow anybody in finance, they're always talking about banking on yourself and infinite banking and things like that. But I think the biggest issue that people make, or the biggest assumption that people make, is like Zack said, is, okay, I can afford to put $500 a month in this policy. Okay, awesome. And then you show them that illustration. Well, $500 a month, 10 years from now, might have some cash value that you can pull from. It's not going to be this beautiful, magical, I'm going to buy a house next year, because you're only putting in $500 a month. So before you can be your own bank, you have to build your own bank, right? And building your own bank either takes upfront capital, or it takes systematic savings. And that's what people, a lot of times, we live in a now society. We want it now. We want it right now. And a lot of times people don't have the lump sum money to make it happen right now, and they don't want to wait on that compounding and that growth through the years to do so. So I think that would be the other piece that I would tell you, is it is a fascinating concept. It makes so much sense, as long as it's structured properly and you actually have a bank that you can borrow from. And sometimes that's going to take you a minute. So just remember that when you think that through.
Yep. And there are ways to set up a family bank for future generations, even if you won't be able to take advantage of it during your lifetime, via death benefits, inheritances, those kind of things. So a lot of questions about this. I know Sorrell's got his hand up already. So we want to open it up for Q&A, and then we'll go from there. Go ahead, Sorrell.
Oh my God, I too am in love with the bank on yourself concept. I wish it worked with the $500 today, 20,000 tomorrow. But
I mean, right? We can
but I-
perform magic, but not quite that well.
I did hear you make the comparison between a cash value policy, borrowing from that, and a 401k plan, withdrawing income from that. Were you by chance suggesting that creating a bank on yourself environment could be a valid substitute for a 401k in someone's retirement years?
So that's a loaded question, and I'll give you a vague answer.
The
right?
answer is yes. That's why it was
In-
suggesting.
in-
Okay, now he can give you
It's comparing apples to oranges, right? So we subscribe to a philosophy of free money. As far as in order of investing, we want to invest in free money, then we want to invest tax-free money, and then we want to invest taxable money after that. So in a 401k, matched money is free money. So if someone has the ability to get a match from their employer, I'm going to say, you put in that 3%, they put in that 3%, you're guaranteed a 100% rate of return on every dollar you put in that 401k. That's what we call free money. Beyond that, I'm going to look from, before I overfund over the match in my 401k, I'm going to look at the entire picture of the individual, right? Obviously, we want to grow tax-free buckets for them, but we also don't want to put them in a bad tax time at this point in time. So if we go through those free money, tax-free money, taxable money, then we can circle back around. 401ks, they make me really nervous. In the long term, we saw it in 2009. I'm afraid we're going to see it again now, because when people reach retirement age and that is their only vehicle, and we're in a down cycle in the market, the 401k can be a disaster, because
and taxes
going up and the value going down means that last year you could have retired and you thought you had a long-term income, but even if you retired last year, that 4% that you could withdraw, or that 3%, is now off of a smaller bucket. So I like to have, from an income perspective, more pieces. So it's apples and oranges. Hope that makes sense. Depending on where you are in your savings career and your savings, I'm a big fan of younger people getting started, looking hard and fast at the 401k and what's being offered there before they just sell out to that for their retirement piece down the road.
Mhm.
Our three-legged stool of retirement, of pension, Social Security, and private savings, is now pretty much a one-legged stool that's called a 401k, which is our own money. So we've got to build those other legs back in another way. So
And I think to answer that question similarly, but to expand on it, I think in my opinion, most of the time, the only time I'd use a 401k is for that free money. And then any other time I would look for something different, whether it's a Roth, whether it's a tax-free income stream, with the life insurance piece, something like that, because of the taxable implications. You've got several issues when you're growing your money. Your two biggest enemies are taxes and inflation, right? And maybe market risk if we count three of them, right? Well, taxes are going to go up, zero question. Inflation is 9% right now. Market risk, we're headed into a recession like a freight train headed off a cliff. Like, all of those pieces are going to significantly affect you inside of your 401k. Inside of a life insurance policy, there are no taxes.
Most life insurance policies, no taxes, yes, but I thought you were talking about risk.
No, are no taxes. The majority of them have the ability to outpace inflation, at least on a systematic basis. That's kind of the goal with that. And as far as market risk, there are some variable policies that have market risk, but most of these bank on yourself concept policies, whether it be whole life or index universal life or whatever, they're guaranteed never to lose. So if you can take away your three biggest enemies to your money and have the ability for that to grow and borrow from it instead of withdraw from it and allow it to continue compounding, I think for me, I think it's a huge piece, especially in the retirement planning piece, more so than the infinite banking. For infinite banking, meaning I'm going to buy investment properties with this money sitting in my account. To me, I love it for both, but it is reality for people that have the ability to do systematic monthly savings for their retirement, like their 401k. That's, to me, a no-brainer for most people, as long as medically they qualify and it's written properly. Cece, you have a question? Oh, sorry, Sorrel.
Yeah.
Oh, thank you. I love this this topic, but I had a question about buying whole term or whole life insurance as a senior citizen, and what would the benefits be if, let's say, I got a lump sum of money and I say I'm going to buy some whole life insurance so that I can, at least maximize borrowing my own money out of the whole life policy, and what kind of limitations are involved with that?
I think as a senior citizen, unless we're talking about a significant amount of money, this is not the tool for you from an investment portion. If we're talking about a death benefit, if we're talking about a legacy play to leave your family, if we're talking about a final expense policy to make sure that all of your final expenses are taken care of, awesome. But most of the time, obviously, life insurance gets significantly more expensive the older we get, right? And a lot of times the older we get, the different our health is, or the worse our health might be. So a permanent policy is going to be very, very, very expensive as a senior citizen. So I don't think, probably based on the cost of insurance and how much you have to put in to actually use it as a bank on yourself, that it's a concept to use as a bank on yourself. I think it's more of a legacy piece, a final expense piece, or just those conversations. If you were looking for a bank on yourself piece and you had money to do so, I would look at borrowing a kid's life, a grandkid's life, something like that, so your money actually grows. Sorry, Sorrel, I didn't mean to cut you off.
No worries. Just a piece I wanted to clarify so I can understand, so we can all understand it. When I borrow from the life insurance policy as a means to augment or subsidize my retirement income, I'm thinking in my head, oh, I borrow that, but given that it's my money, I'm borrowing with the intent not to pay it back. And what it does, it actually reduces the death benefit upon my death.
Typically, yes, depending on obviously your performance inside your policy and things like that, but typically, yes.
If you pass away with outstanding loans, those are settled directly from the death benefit proceeds before your beneficiaries get what's left.
Yeah.
But it's still a tax-free event. So in essence, you've still not paid taxes on it. It's after-tax dollars going in, but all the deferred growth, because you followed the life insurance rules, was never taxed.
Yeah, makes sense. I get it. Thank you. That's the miracle of today.
It is, yeah, it's fascinating for sure.
Pretty cool.
I know we're right at time. I know it's a hot topic, so you guys can leave us a chat or message us on Facebook if you want us to continue this conversation. We're happy to do so, and we could maybe do some illustrations and show you what it looks like, for a 25-year-old starting out, or a 50-year-old, or a bank on yourself concept, just so you guys can see. But if you want more of this information, let us know. But if not, then we'll come up with a different topic, right? And talk about something different. But you guys enjoy your day, enjoy your holiday. Thank you, like Zack said earlier, to all of the men and women that serve our country, both in the past and now. And we obviously appreciate all of you for what you've done to keep our country free. So enjoy your Memorial Day. And
as we leave you guys every time, we remind you to love, laugh out loud, stress less, eat mostly plant-based.
Except for your barbecue.
Today's a barbecue day. So give and sleep, move, get up and move today, and then check yourself before you wreck yourself. Take a pause and wait for your reaction. So guys, thanks again for being here. We enjoyed it. Hope you got something good out of it. And we will see you same time, same place tomorrow on the Daily Huddle.
Bye, guys.
Thank you, Kimberly. Thank you, Zack.
Thank
you, family.
you. Awesome job. Thank you.